Good morning, friends and colleagues. My name is Brian Caldwell, and I'm the Strategic Account Manager here at CompStak. And I'm excited to welcome you guys to our webinar today, where we'll discuss the top 3 themes for commercial real estate going into the new year. A few months back, we hosted a similar discussion with Casey and Michael, and we're excited to catch up again on the economy and commercial real estate. As we approach the end of the year, how much better or worse do things look now than they did 2 months ago? And what specifically has changed? Most importantly, what should we be paying attention to as we prepare to enter the new year? We'll kick the program off this morning with some introductions to our panelists. And we'll start with our CEO and founder here at CompStak, Michael Mandel. So Michael founded CompStak in 2012 with the mission to create transparency in commercial real estate by gathering information that's hard to find, difficult to compile, or otherwise unavailable. The world's largest brokerage firms and preeminent real estate investors use CompStak's commercial real estate data to compare properties and make investment decisions. Before starting CompStak, Michael was a commercial real estate broker and led the New York Metro data center practice as a leasing agent at Grubb & Ellis. Our next panelist for today is KC Conway, who is co-founder and principal of Red Shoe Economics, a research and consulting firm offering multi-dimensional perspectives on the economic influences affecting the commercial real estate industry. Casey is also chief economist for the CCIM Institute and has spent the last 35 years of his career as an appraiser, bank regulator, underwriter and credit officer, economist, investor, and expert witness. Red Shoe Economics is an independent research and consulting firm exclusively serving today's commercial real estate community, providing organic research initiatives, reports, and insights on the impact of applied economics on our industry. The company's 4 pillars include economics, forecasting, valuation, and consulting. And finally, I'm excited to introduce you to our moderator for today's program, Ali Bauman. Ali is Director of Commercial Real Estate Intelligence here at CompStak and joined our team earlier this year after spending her early career in commercial real estate research at Newmark and at the Alliance for Downtown New York. And with that, I'm excited to turn it over to her.
Thank you very much, Brian, and thank you for the introductions. I'm excited to be with you here all today. Wanted to briefly introduce sort of the run of show today. We're going to go through interest rates, rising debt costs, and declining values, and we're going to cover each of the 4 sectors which CompStak provides data on. And a quick note, I'm the Director of Real Estate Intelligence. Real Estate Intelligence at CompStak produces content, research, and a weekly newsletter using CompStak's best-in-class data. We worked with KC Conway today to produce this webinar, and I encourage you to engage with us, follow us, email us. We'd love to hear from you about what you would be interested in seeing with our data. So with that, let's dig right in. We have a lot to cover. As Brian noted, we had a webinar with Casey 2 months ago, and we're interested to see if anything has improved since then, especially in regards to inflation. The last time we spoke, Casey said that inflation would continue to be an issue by the end of the year and interest rates would still continue to rise. Oh, excuse me. And Casey, with that, can you go over where we are with inflation? Are we seeing any improvement after the Fed's actions throughout 2022?
So honestly, I wish I could say yes, but I really don't believe so. But the market has kind of misinterpreted some things. So we saw CPI, the latest numbers, pull back below 8%. PPI, which is the input of goods, which will eventually filter into CPI, stay steady at 8%. So what kind of happened over the summer for everybody to think that inflation had peaked was we had the Strategic Petroleum Reserve releases. And so we released 180 million barrels of oil. We brought energy prices down. The energy component, kind of brought the overall inflation number down. That ends very shortly here, and we'll see the energy come back up. We've seen oil go back above 80. We know the problems in Europe. So I think we've had a little bit of a head fake on people believing inflation had abated. It was all energy from the SPR. But when you look at the wage inflation, the latest numbers from the jobs report last Friday was another 5% increase. That didn't make the Fed very happy. The food inflation stays very strong. Any of us who go to the grocery store know that. So I don't think we've seen the abatement. Some of the numbers are confusing, but you got to understand the SPR oil releases as to kind of the answer as to why.
Mhm. And inflation is still rising, employment is up, but people are feeling more negative about the economy. Why is GDP up in the third quarter after 2 quarters of decline?
I'm so grateful you asked that question. So I wrote a piece on it after the GDP came out and we saw the third quarter became positive. And there were 3 things that drove that weren't present in the first 2 quarters of GDP, which were negative. The first and biggest one was the SPR releases. Those were accretive to GDP. They were treated in the calculation like we had done manufacturing or was an export. So you put 180 million barrels into the market, at $80 to $90 a barrel, that has a big impact on GDP. The second thing was the funding that we did in defense spending for Ukraine and the Ukraine-Russian war really came in the third quarter rather than the second or in the start of the war. In the first quarter, so you had huge uptick in defense spending. And then the third thing was we all discovered with a strong dollar that Europe was on sale. So we all went to Europe for the end of the summer. So you take those 3 things out and GDP would have been negative. I think we don't have those 3 things. We might have the defense spending for Ukraine, but we definitely won't have the SPR releases and we won't have everybody going to Europe. So I think GDP returns to being negative here in the fourth quarter and in the next year.
Got it. That's great insight about GDP. So the next thing, if some of this economic signals are mixed, job growth is still here, but moderating. Why is everyone feeling so negative about the economy? Why are we feeling miserable?
Because they've been reading the misery index, right? If we look at the old misery index from the 70s, it was, you had unemployment and inflation. It got up to 13% in the Jimmy Carter era. The modern misery index from Steve Forbes added GDP and the S&P 500. Everybody's seeing what's happening to their stock portfolios. They're feeling miserable. And I think they're noticing that things at the Fed are not. Look at things like job cuts. We've had 80,000 tech job cuts in the last, 60 days, the Challenger Gray data. We've had over 320,000 so far just since the end of the summer or year-to-date numbers. So I think the household, the average American is looking at job cuts. They're looking at their shelter costs. They're looking at their grocery bill. And they're just not buying this story that's being spun by others that it's all okay and we're going to be good. I'll give you one last statistic to show you how mind-boggling and upside down things are. So most of you remember the LIBOR rate was extinguished this year, and we've been converting to the SOFR, the overnight funding rate, principally run by Freddie and Fannie and the New York Fed. So imagine LIBOR was always very low. It didn't have a lot of volatility. It didn't move up real high or real low. It was a lot lower than the 10-year Treasury. The SOFR this morning is at 381 and the 10-year Treasury is at 355. When in the world would we ever think that something like the SOFR LIBOR equivalent would be higher than the 10-year Treasury? The world's upside down.
Yeah, that's great insight about how wacky things are. And more broadly, the CRE industry, how are they reacting to all of this economic news? Are people in the CRE industry feeling more negative than sort of the general public? What are you seeing there?
Yeah, they're starting to. So we've got the CREPI index up here, which I was involved with creating a year ago for the CCIM Institute. It's the Commercial Real Estate Performance Index. And we back tested it when we created it. And we saw that in March of 2009, it hit its all-time low. And then as we've gone through here, we started the year off with it pretty high and above 90. But we saw it drop really steeply here over the summer, June, July, August, to new all-time lows. And what was really happening, these are 10 forward-looking indicators like consumer confidence and Green Street commercial property price indexes and stuff. So they're forward-looking windshield, not out the back rearview mirror. And then they tell us kind of where things are headed. Well, what happened is, if you remember, January, no Fed increase. February, they took a break. March, they came back and said, okay, we'll do a 1/4 point increase. April, they took another break. May, they said, okay, maybe we'll go to 50. And then after that, they've gone 75 basis points ever since, waiting to see what happens at next week's meeting. So what happened is, in all these indices like consumer confidence and cost of capital in our real estate world, none of those were materially affected until really we got in here into May, June, and July, and really the second half of this year. And that's where the commercial real estate industry is starting to feel the pinch. They're feeling it in 2 ways. Number one, expenses are growing at about 3 times the rate of rent growth. So their NOI is dipping down. And then what's to come is they got to figure out what's the price of real estate, given all of these rate increases. And I think, a lot of people follow the Urban Land Institute's Emerging Trends. They just released their 2023 report. And the number one item that was across all ULI members in their report was that buyers and sellers cannot agree on pricing. Sellers still think the real estate's worth a lot and like what it was 6 months to a year ago. And the buyers are saying, not so much. The capital's more expensive. The expenses are higher. So we're about to see through next year, I think, the real correction in commercial real estate prices.
And we've talked about this in prior slides, but next week is the final FMOC meeting for 2023. So far, we've had 6 interest rate hikes. What do you expect for next week? And what does it mean when the yield curve inverts? What does that mean for CRE?
Right. So we'll get another increase, and I'm in the camp. It's going to be at another 75 basis points. And if you really want to see the dual off, look at the commentary from Jim Bullard from the St. Louis Fed that says, look, I've been right on this for almost a year and a half. We need to just crush this thing. And he wants, 100 basis point increases. He's calling for the overnight federal funds rate to go to 7%. Everybody thinks it's going to stop at 5. We'll come just shy of 5 if they do a 75 basis point increase. So I think they do a 75. There were 2 critical data points that we've been waiting on going into this December 13th, 14th meeting. The first was the job reports last Friday. It came in hot, 263,000 jobs, about 63,000 more than expected. Wage inflation up 5%, unemployment still at 3.7, and the labor participation rate falling. So that was not a jobs report the Fed wanted to even say, I'll cool back to 50 basis points. The big one, though, will come on December 13th, where we get the new CPI data. And if that comes in hot, I think you've got a 75 basis point hike for sure. And so what that all means when we look at the yield curve. So that really, we look at what's the difference between rates and treasuries at the short term versus the long term in duration. So the 2-year, which you shouldn't have a lot of risk, it should be lower than the 10-year, because if we think about our risk premiums for duration, a lot more bad things happen over 10 years than they do in 2 years. So when they invert, what the market is telling us is they're very, very worried about the near term. And that's what the market's telling us. We have a 2-year at about 450. We have the largest spread between the 2-year and 10-year in its history, breaking even the 40-year record back to the 1980s. So what it's telling us is the market has a lot of anxiety, is very freaked out about the near term. And on the long term, they think the Fed will just get this out of their system and we'll go back to normal in 2 years. I think it's going to take a little longer than that, but that's what it means. Short-term rates higher than long-term means the market's freaked out for the short term.
Excellent insights on where we stand with the economy. Now, with interest rate hikes, that means the cost of capital is rising. How is that impacting CRE values? And are we starting to see any change in cap rates or values yet?
So it has a big impact. And this next slide shows you a simple little tool from one of our fellow CCIMs, Greg Howe, and he's fine, emailing him, or he put it on LinkedIn. But what he did is he looked back at last January and looked at where we had a 3% 10-year treasury, and banks willing to lend up to 70%. And you could justify cap rates in a 5% doing your band of investment. Cost of my debt plus the cost of my equity weighted together, I could get into a 5 cap rate range. Fast forward to today. Banks aren't doing 70% loan to values. In fact, they're not doing much of any. But if they do one, it's 50 or 60%, and they want more debt service coverage. And now you look at a 10-year treasury that I think after this next rate hike will be more like 5%. You filter that down, and it's hard to justify a cap rate below 7.5 to 7.75. We have not seen that happen yet. That's what's going to play out next year. We've seen the impact from expense growth being greater than rent growth. And so that's the first dip that we've seen. The second dip comes when everybody reprices the cost of capital into the math of a cap rate. And that's what worries me most, is the capital constraint next year and the repricing. In fact, the other big conclusion out of the ULI Emerging Trends was that property returns are primed for a reset. And what they're really talking about is resetting the cap rates with all of these rate hikes. It's to come. It's out the windshield. Be looking for it.
So some indexes are already beginning to show a decline, even if cap rates haven't come down wholesale yet. What is happening? What can we surmise from Green Street's CPPI?
Yeah, and this is what I just commented on. So this is the dip we've seen. All the property prices have peaked. Green Street's more the institutional quality real estate. So even the institutional gateway stuff has peaked and coming down. And this is all due to expenses growing at such a fast pace that the rents can't cover them. And so that's step one. And then step two comes the cap rates. But RCA and and CoStar have them, and then you guys are doing a great job tracking this as well with your transaction data that you've got now.
And it sounds like your major takeaway from what's been happening is that there is a repricing and a pricing mismatch between buyers and sellers. Is there more of that to come?
There is. I think that's all in our windshield. We aren't even in the first inning yet. And so you get all this capital that's got to place the end of the year. The pension funds, wring the rest of theirs out. The bank shut down. And we come into January and had a nice Christmas and Hanukkah or whatever. And we'll find out that it's back to no cash for nobody. Remember the old legacy bank out of North Carolina, NCNB, that became Nations and Bank America? We used to joke during the recessions, it was no cash for nobody. That's what I fear. And that's what ULI is saying, is that sellers have not adjusted their expectations to where buyers already are. Buyers are already there using higher cap rates. Deals are falling out of escrow. Banks have been told by the Federal Reserve that lending is inflationary. So knock it off, do no lending. And in that we've got to reset our new norm. We got to reset what cap rates are. We got to reset multiples. We got to reset price points, preferred markets, preferred property types. All of that is ahead of us. So I think that 2023 is going to be the year we thought 2021 was going to be. 21 turned out to be great, but we thought it was going to be miserable. We're now paying the price for all this, quantitative easing and fiscal stimulus and COVID stuff. We're now having to figure out how we unwind this, and it's going to be harmful for real estate, and more so for certain property types and less for others.
And Michael, I'll turn to you at this next slide. So the industrial market over the past 2 years has been extremely robust and cap rates have compressed. We track cap rate data for the industrial market as well as other sectors. What are we seeing in our data so far?
Yeah, so happy to dig in here a bit. It's interesting. Obviously, we're tracking cap rates across sales transactions, across the U.S. And in this case, we look specifically at institutional industrial assets, major landlord investments, and you can see cap rates have continued to go down quarter over quarter for years. We're not expecting that to continue, but they've continued to go down going into Q3. And in chatting with KC about it, we were speculating that a lot of that is driven by the fact that this is a trend line for institutional investors, and a lot of those have access to a lot of equity. And so if they're really high quality assets with quality tenants that are producing great income, they're still able to invest at relatively low cap rates if they're doing it without debt. Or minimal debt. But, I think ultimately you're going to see even those transactions shift to higher cap rates, but also there's fewer transactions taking place, right? So this is reflective of those transactions that those major investors have made, but they're making fewer transactions than they were because of the environment. And there's naturally always a decline in transaction velocity when you're in a position, a moment of transition, as KC was alluding to, where sellers don't want to sell at a higher cap rate, and the buyers don't want to buy at the cap rates the sellers want to sell at. And so as a result, you're at a stalemate and there's just fewer transactions happening. And so a recurring theme you're going to hear from me is interesting things that we're seeing in our data as a result of a decrease in velocity overall, and the impact that that's having.
Thanks, Michael. Well, decrease in velocity is a good transition to our next topic. We're going to spend a big chunk of time talking about what's happening in the office market and the structural shift that we're seeing in the sector more than 2 years after COVID began. So KC, I'll turn back to you. So recently we've seen that pension funds and large institutional owners are sort of getting out of the office market. This is a chart that shows the NCRE MPI. How should we think about the office sector?
So as Michael will reiterate, all real estate's local. And so you got to distinguish between gateway markets that maybe institutional money wants to stay in versus the broader market and suburb versus urban. But generally the pension funds have said, look, we've had 25% of our capital in office, and we're not so bullish on that anymore. We think we've already lost 15% of our value, and we're afraid we could lose another 20 or 25% with the cap rate adjustment to come. And they would rather be 25% industrial instead of 15%, and maybe only 15% in office. So what you're seeing is a rebalancing of capital allocations. And I think showing that they're probably more flexible, more negotiable on prices for office. But you'll see certain markets, as Michael will talk to, that are differentiating, and we have to kind of differentiate those from the macro market in suburban versus urban and the gateway markets, because they are performing differently. I don't, if you want to comment on that, Michael.
Well, actually, I wanted to touch on a question that came in that I think is relevant to this. There was a question of, will you actually see it from Teresa? Will you actually see a decline in sales price or just no sales as property owners hope to ride out this period? And I think this slide speaks to it. Whereas you've got these major institutional players that are concerned about portfolio balancing and the holdings on their portfolios, and so they're selling at and taking hits on properties now in order to balance their portfolios and to invest in more industrial and offset the office. And so I think that I think that even more so today than 10 years ago, as more and more family owners have come out of the market and more institutional owners have come in with shorter hold periods. I think that actually introduces more volatility, which will drive lower prices, presuming that this economy continues to be crappy. But KC, what do you think? I mean, I think that this probably reflects that here.
Yeah, I love your new economic term there. I use a few of those myself, and when you don't have your PhD, you can use creative economic terms. But the phrase I'm using for those that are looking at office today is, will remote work do to office values what e-commerce did to big box retail? And I'm in the camp that for the high density, office, urban office, particularly where you're not seeing the back to work come real dramatically, that it's staying below 50%. I think that's what happens. And you do have this rebalancing, and, office isn't in favor. I'll give you the shocker. So I was involved in the first ULI emerging trends when it was started by Equitable Real Estate over 25 years ago. And we never thought, it was malls and office that were at the top. In industrial, who wanted to play in that dirty stuff? And apartments were, that was for the, GSEs. We didn't want to do that. In the new 2023 urban ULI's emerging trends report, hotel became the #3 preferred office class for investment and development, and displaced both office and retail. I never thought I'd see that in my career. So when you see these kinds of psychological and preference changes happen, you have to have a valuation correction that comes with that. So I think you're exactly right, Michael.
Yeah, although, interestingly, and there's this next slide here touches on this with Salesforce ordering some workers back to the office. In some regard, the economic environment could be a really good thing for office, because we were in a situation where originally people weren't back in the office because of COVID, but then they weren't back in the office because employees didn't want to be back in the office, and employees had a lot of power. The employment rate was incredibly low, and employers just didn't have the leverage that they once had, and so they had to do what their employees wanted. Well, now that's not so much the case, and tech was at the forefront of allowing people to be remote. And Salesforce came out very publicly and said that they weren't requiring anybody back in the office, and now are saying that their sales team has to be back 3 days a week, which is a massive shift. And so I think you could argue that one positive takeaway for the commercial real estate space, and for office particularly, is that as economic conditions get worse, employers have more power, and if employers want employees back in the office, occupancy could go up. Now, that said, obviously a way to cut costs is to cut your office space, so that goes the opposite direction. But KC, do you want to weigh in on that a bit as well?
Yeah, I'll throw in my conspiracy weirdness in here. So I'm actually wondering, with the tech layoffs, is that the companies that switched and said, okay, we'll tell everybody they have to come back to work, and they'll all quit, and we don't have to pay unemployment benefits. But one way, this tech workforce that really doesn't want to be back in the office full time, if you force them, that's a way to force kind of reduction in your staff. And if that's what you're trying to do through job cuts and not have to pay the benefits, you can do that, and then you can dump the space and get a 2-for-1. But I don't know what's going on this side, but I think the employees have the power, and we're seeing hoarding of employees, and particularly in parts of the tech sector. And when Twitter said we're going to lay how many thousands off, and what they found out was, oops, we needed to keep some of those, and now we want them back, but they've already been soaked up and reemployed. So when you look at how quickly some of these skilled tech workforce are being picked up, I think they still are in control, and they're going to tell the employers how and where they're going to work. And if not, they're going to they're going to kick us out because we're old, right? Like me.
Well, a conspiracy theory, I suppose, or and on the flip side of that is that some of the people who are advocating for back to the office the most are the people who have the long-term lease obligations, and some of the people who are advocating and saying that remote is great are the people whose leases were up and they don't want to have to sign new leases. So that could be another approach to what's happening as well.
It's all on you guys at CompStak to sort this out for us. We're relying on you to tell us what's going on, Michael.
Fair enough.
Well, thank you both for that. I think it's a really interesting way to think about the office market, and that e-commerce didn't totally kill off brick and mortar retail, but it's probably a lot different than when e-commerce first became a major trend. So there's clearly going to be winners and losers in the office market as we undergo this structural shift. One of the major things impacting the office market is that expenses due to inflation and other pressures have been growing faster than rent growth. Michael, what have we been seeing in our data as compared to expense increases over the past few quarters?
Well, the first thing I'll point out, which I think, might be surprising to a lot of people, is the chart on the left, which is that we're showing that there has been rent growth and the rents have come back to where they were, which probably most people are going to say CompStak is crazy. That doesn't make any sense. That's not what I'm living. And it is reality, right? But the challenge is that we're talking about averages. And in this case, we're talking about gateway markets. And what happens with averages is when you pull out a certain type of thing from that average, you get skewed by whatever's left. The thing that we're pulling out here, not intentionally, is Class B and C, or in the case of Class A, older Class A buildings and older space within Class A buildings. And we're going to talk a lot about this, but basically what we're seeing is that the Class B and C deals and the deals in the old buildings and the unrenovated space deals are not happening. And the deals that are happening tend to be disproportionately in Class A buildings, new buildings, trophy buildings. And so while those rents are likely getting done meaningfully lower than where they would have gotten done a few years ago, they're still higher than the rents in Class B and C. And so they're driving the rents up. And so the averages are actually staying up in a way that we probably didn't expect. But it's pretty interesting. And actually expenses tie into that directly, because if you are a tenant and you were going to take a space and you were going to build it out because it's an old space and you were going to build it out, well, the cost to build out that space is so astronomically high that you're not going to do it. You're going to then take a build space, and that build space, will be at a higher rent. And so, because expenses, as you can see on the right, expenses per square foot have been, trending meaningfully higher than effective rent. And you can see that yellow line is with maybe one exception here, has been higher than the blue line consistently since third quarter of 2019.
Yeah, I think that point's really important for everybody to soak in, Michael. And I think the other one is, if you look at why office rents can also be rising and that be counterintuitive, is that they're on a gross basis. So they include the expenses with an expense stop. So as you're rolling over and you're doing new leases, you're resetting those expense stops at a higher level. So it could be more that the expense piece that's in that full service lease is what's going up and not really the real estate piece. But I think your other point too is, if you got to look at renovating an older building and you can't get materials, you don't know when the labor is going to be there, how long it's going to take, whether it'll be done in the time you're ready to move out. And it could be even more expensive than going into a new building and being ready to go that's already built out. That's a clear choice and you're not going to negotiate as hard. So I think that's a really important point.
Yeah, and I think, to your point, basically, what does that mean for the office owners? It means their profit margin's lower. Their net operating income's lower. The rents are going up, but not as much as the expenses. They're making less money. And we'll talk about industrial and kind of the opposite effect there.
So returning to this idea of there's going to be sort of winners and losers, to put it one way, in this structural shift in office. Like we've heard a lot about suburban office having a comeback in this post-pandemic environment. And I know, Casey, we've spoken a lot about that. But Michael and Casey, what are we seeing, again, returning to the performance in NCREIF, which tracks institutional properties?
You take the first shot at this one, Michael.
Sure. Well, first of all, you'll see that occupancy is much higher in suburban than in CBD, which is interesting to see. And you've seen this, precipitous decline in occupancy rates within CBD. But when you look at the returns, on these properties, you can see that during the pandemic, or as we were coming out of the pandemic, there were higher returns as more tenants started thinking, maybe suburban's the way to go. People want to be closer to home. You were seeing higher returns in suburban versus CBD meaningfully, but now it's all compressed. Now the returns are coming down pretty consistently across the board, in a nearly vertical drop.
Yeah. So, what I see, Michael, is that, the companies are being forced by their employees to say, look, I'll come into the office, but I want to be out near where I live. So when you look at the metrics kind of on absorption and occupancy, the suburbs seem to be doing better. But if you think about that office building, it's smaller leases, shorter term duration, maybe not as much credit tenant in there versus your urban buildings have longer duration, more credit tenants in those buildings. So it's kind of that balance. Does the occupancy and absorption benefit in the suburbs offset, that you don't have the same credit, you have more turnover, you have more TI costs, you've got less credit quality. I think that dynamic is playing out here. While you're seeing both go down, nobody really wants the office. They both have risks, but one's more on the tenant, smaller tenant, less credit quality, higher turnover costs versus the CBD, which is credit tenant, big spaces, longer duration. And they're both kind of doing their own thing, but they're both going down the slide at the same time.
Yeah.
Another
And
economic
I think, there was a level of optimism, in the first half of 2021, or people started coming back and the economy seemed like it was all right. And then as the economy got worse, I think the momentum around leasing office space was reduced because the momentum about spending money on anything was reduced. And so that's really an impact. And meanwhile, leases keep rolling, expirations keep happening. I think, if I recall from our last presentation, we talked about I think there's the most lease expirations coming in 2023, but there's a lot in 2022 as well. So that's going to be a real challenge. Yeah,
the big window for your clients and what are not there is, unlike 2009, where we had that big wall of maturities and we didn't know how it was going to play out and everybody was freaked out across all commercial property types in CMBS. What we found out is we didn't know that everybody was going to allow interest only, kick it down the road, and that the Fed would keep rates lower for that process. So we have just the opposite occurring here. And we kind of don't know how that, how all that's going to, kind of play out here. But I think we're in a systemic change, and that the office asset is out of favor from all the other. When hotel bypasses you, it's kind of like that tortoise, when that tortoise runs past the rabbit because he's taking a nap. You better be worried. When hotel bypasses both retail and office, there's something systemic going on here that we need to pay attention to.
So we decided to use this suburban versus CBD trends happening in the institutional data as a jumping off point to see what's happening in CompStak's data. And we analyzed CBD versus suburban markets within gateway markets only, which includes New York City, Washington, D.C., Boston, Dallas, San Francisco, Bay Area, and Chicago. And Michael, we found something a little bit different, which goes to flight to quality. Can you explain what we're seeing here?
Yeah, I mean, I'm going to repeat this a million times, but we're seeing effective rent growth in both Class A in CBD and Class A in suburban, almost the same, 7.8 Class A CBD, 8.1% suburban increase in rents, but a huge decline in effective rents when you're looking at suburban, the suburban of areas of gateway markets. For Class B, 9.9% in CBD, and actually meaningfully larger decline in suburban Class B. And I think again, it is actually following the trend a bit from what we saw before, which is that beginning for Q1 2022, there was this optimism, and then we see the drop off. And we didn't see as big of a drop off in suburban before. People had this, in 2021, people were thinking, suburban office is going to be where people want to be. And so the rent stayed high, as that there was some interest in doing that. But I think that trend is, my opinion, is that trend is no longer a trend, that people are not excited about suburban in the way that they were, or thinking that suburban was going to be up, a savior, in the space. And so it's now seeing the drop off to kind of match the earlier drop off that CBD had.
Yeah, I think you may be right exactly, Michael, on the gateway markets. And what is important for the audience is to hear, that's what you're comparing, kind of the gateway, the suburban. If they're forcing you to come back to work, you should see that strengthening of the Class A in the urban. And I think in the rest of the country, we're kind of seeing the opposite because they don't want long commutes. We don't have the public transportation. It's close to our work and kids' school and whatnot. So like I'm in Atlanta, and we've actually seen such a big suburban market, but the northern suburbs in particular have done very well in the rent growth and come up. You look at places, like in Arizona or Colorado, and even in the Texas suburban markets. I think it's a little different story, but I think you caught a neat niche here on the gateway, suburban versus the Class A in the gateway. But for the audience, don't extrapolate that to the secondary markets around the country.
So it's definitely a bifurcated market where a trend for one part of the market is not true for the others. So here, what is happening with concessions though in gateway markets in the CBD? What are we seeing?
Yeah, well, clearly, the spread between starting rents and effective rents has grown. So that means that there's more concessions, whether it's free rent or TI. There's a need for more TI as expenses go up. So, that's clearly happening, but also free rent, I think still as people have eased back into the office, there was a want for more free rent to sort of accommodate that, a bit. And in suburban, I would say that spread is clearly, it looks like it's grown even more so, although it's now compressed a bit, but that might just be an anomaly in the data that we're seeing in Q3.
Yeah, I think it's all those expensive foot latches and those stickers on the floor that say stay 6 feet back. They're just killing it on the TI costs, right?
And returning a bit to flight to quality or trading up. KC, you noticed this great analysis from ULI. What can we take from this chart on the left?
Well, it's kind of what you guys at CompStak and Mike have been talking about, is that they want quality, that the newer buildings and the quality buildings where you can move in and have all the kind of bells and whistles features that you need, they're doing better than the older type stuff. So I think it's very consistent with Michael's comments and what you're seeing in the gateway markets. I don't know if you want to elaborate on that, Michael.
Well, I'm a little skeptical of this chart on the left. I think it shows something. I think it shows something that is incredibly dramatic. I don't believe that reality is as dramatic. These are buildings that are built since 2015. If they're signing, 10-year leases, none of those leases are up for expiration, and new buildings tend to sign Class A type credit tenants, so they're probably not defaulting. They're, so they're just holding on to these leases. So there isn't a possibility to have negative net absorption in a new building if you sign these leases and the leases haven't rolled yet. And so it's showing a steep, positive absorption in those newer buildings. But I think that you have to have the context that it wouldn't be as steep if not for the fact that if you signed a lease in 2019, you're stuck with it for all intents and purposes.
Yeah, and I think what ULI was kind of picking up here too, that didn't get fully communicated in a chart like this, is they're factoring in the impact of sublet space. So the lease is still in effect, and it might not show the big buildings having a turnover, but when you look at even a market like Atlanta, you can look at Midtown and Buckhead and downtown, where you're looking at 20% of the space in the newer buildings in the Class A is up for sublet, and so that hasn't factored into the lease rollover. So you're right. You really got to dig beneath the numbers and say, is this too dramatic to tell me something different? My personal belief is that this is where the sublet factor is kind of coming in. It may not have rolled over, but the space is on the market, and the brokers can't talk about it, or they'll get fired by the property owner.
but this is an environment in which we don't track shadow space. I don't know if you guys know the term shadow space, but shadow space is space that it's available. A tenant would happily sublease it or give it up or give it back to the landlord if they could, but it's not on the market, right? In an environment like this, you're bound to have massive amounts of shadow space, because when you've got very high vacancy and rents are going down, you may not even bother subleasing your space because nobody's going to take it. And if you only have a short term left on it, a year left on it, why even bother wasting your time? That doesn't mean that you really want it or you're using it. And so, there's a real aspect there that to bear in mind. And then, of course, this is, looking at vacancy and occupancy as a means of, is the space leased or not whether it's physically occupied or not, which are two very, very different things.
Yeah, great points.
So digging in again, just sort of comparing New York City to San Francisco, we analyzed, broke out Class A, without trophy or new construction compared to Class B. And we see sort of a substantial difference between New York and San Francisco. What do you think about this trend, Michael?
Yeah, this is maybe my favorite slide in the deck, because it's really, this is one that is dramatic and I think is correct in its drama. First of all, you see, an increase in Class A effective rents. But then when you really dig into it, so that's the black, that's New York City, 5.1 increase in Class A overall effective rents. But then if you look at the blue bar next to it, that's Class A once you take out trophy buildings and new construction buildings. And all of a sudden, you're seeing a decrease in Class A rents. Next, you've got Class B, again, a small increase in rent in Class B, but once you take out renovated spaces from Class B, renovated buildings, now again, you've got a decrease in Class B rents. So this is fully, reflects, what we're talking about around a flight to quality. And I'll point out that, in this case, we're talking about flight to quality as it relates to buildings and the quality, whether those buildings have been renovated or buildings have been built. But there's also an aspect of flight to quality that we see come into play in the spaces themselves. Are they recent new build outs or do they need work? That also is driving things quite a bit. So even within the Class A buildings and the Class B buildings, the spaces that are trading are the fresher, newer spaces. San Francisco, it's really the same trend, but just much more dramatic. Small decrease in Class A overall, but when you take out new construction trophy, a bigger decrease. And Class B overall and Class B without renovation have just fallen off entirely. So that's pretty dramatic. I think also what you'll see is that the Class A buildings tend to be larger tenants. The larger tenants tend to sign longer term deals. And so more of the Class B space has rolled. And so as a result of higher vacancy in Class B, you're seeing rents come down faster because the vacancy rates have gone up faster. And average lease term in San Francisco in general is meaningfully shorter than New York. And that has also led to a faster decline in rents. So that's a major impact. The tech companies have always wanted shorter term deals. The San Francisco market has been used to doing shorter term deals, and the rents were going up so fast in San Francisco that the landlords were happy to do short term deals because they kept on getting higher rents when they did their new deals. Now it's really coming back to bite them.
So Michael, I think you're right, and this value this slide, because this really highlights me being a SCART appraiser. The kind of information we always want to get. So if you have a client that's got a portfolio or an institution that's got assets all over, and you're trying to figure out, where do I lose 40% on that office market stuff, or where do I only lose 10%? This is the kind of stratification that helps you understand where you're going to probably have a bigger hit and a less hit. So I love this information.
And I think this speaks to the question around are things going to sell or not? In a market in San Francisco that has become in recent years more and more institutional, but also, depending on the nature of the firm, but if it's a private equity firm that is, they're probably going to sell this. If it's a family owner that's owned it for, 100 years at a low basis, no, they're not selling in this environment, most likely, if, depending on their debt situation. But depending on the nature of the owner, these are you're going to have a lot of distress in the market, and the distress is going to have to drive sales.
So speaking about New York and San Francisco, both of which are major tech markets, especially San Francisco, the past few weeks, months had a lot of negative news. The tech sector was a huge driver of the office sector over the past 10 years. But now it looks to be that won't be so going forward.
Yeah, I think, your two big office users have traditionally been the financial services, and then more recently, the past, couple of decades, technology. And both of those are pulling back in what they need for their office space, whether it's more remote or, consolidating that for expenses. So I think you're right. You need to pay attention to these. That's why I follow the Challenger grade job cuts. It comes out the Thursday before the BLS jobs report. And what they're telling us is a lot less office using need is coming from these cuts.
So the tech sector and FANG, we looked at in particular, even through 2020 and 2021, was sort of still taking office space, even as many of those companies still had remote or hybrid work policies. Michael, what do you think this slide shows about our sort of dependence on the tech sector for the office market?
Yeah, I mean, it's going to be a real challenge. You can see on the left-hand side, the light blue are the rents that are paid by FANG, and the average rents paid by FANG tenants versus the darker blue, grayish color being all others. So you can see that they've paid meaningfully higher rents than the average rents in the market, and they've signed way larger average leases. Now, granted, these are some of the biggest companies in the world, so obviously they're signing larger leases, but now they've come down a lot. The leases that they are still signing today are a fraction of what they were, and so it's going to have a major impact in the market when major real estate investors, developers, have been expecting that they were able to get these guys as anchor tenants, and now they're not. I think the reason why you saw that they were still taking down large chunks of space in 2020 and 2021 was that they thought that this was transient in some capacity and things were going to come back. And I can tell you from working with one of these major FANG clients as a client of ours, they had told us that they plan out their real estate 10 years in advance. Now, not necessarily with their leases. Sometimes it's acquiring properties 10 years in advance and then leasing them out and then occupying them themselves. But they're planning far ahead of their demand, and they were expecting that they were just going to, even in 2021, they were hiring like crazy. And so despite the fact that fewer people were in the office, they just thought they were going to need to take down more space just to accommodate the percentage of people that would be in the office because they were hiring so aggressively. And as soon as the hiring fell off and the layoffs started happening, that was all out the window.
Yeah, that's a great point. Well, that concludes sort of our overview of what's happening with the office sector. Clearly, some causes for concern. With our last 15 minutes or so, we want to touch on the other commercial real estate sectors and jump into industrial. Obviously, it's been the darling of the past 2 years. Are we expecting that it will continue to be resilient in a recession or not? This is the NIOP CRE Sentiment Index. Clearly, players are feeling more negative, as KC explained earlier in the presentation, but most respondents said that they would be active in industrial properties, if anything, over the next year or so. KC, do you have any insight into how we should be thinking about the industrial market?
Yeah, so 3 thoughts that I'm getting directly from a lot of our clients, merchant developers and big retail industrial users is, number one, most everybody is hitting the pause button. They don't know kind of what's going to be the new norm. Are we going to have a recession? How bad is the recession going to be? What are the interest rates going to be? How does the financing go? So they're kind of saying we're going to pause here a little bit for 6 months. We're going to complete what we've got in the pipeline, but we're going to slow it down and we're going to do more smaller. We're going to do more 100 to 3,000 square foot warehouses than take the risk of a big, million square footer. We saw what happened with Amazon and overbuilding. The second thing is that we are remaking our supply chain from really a West Coast concentric LA, Long Beach into Chicago and the East to more of a north-south, where, all but one of our class 1 railroads moved, where we have more port redundancy in the Gulf and the Atlantic. And when you look at the logistics infrastructure and the population, 70% of our population is in what I call the Golden Triangle, the Great Lakes down to Texas and whatnot. And then we've got our railroads that move right through there, the Canadian Pacific and Kansas City Southern rail merger this year as an example. So the industrial we're building and we're going to have to build is going to continue in really what I call that north-south direction. So everything from, Columbus, Ohio and Indianapolis all the way down into, Atlanta, Birmingham and Dallas is going to be very strong. The biggest challenge I think we're going to see in the numbers is understanding that deals that don't get done are because the capital pulls back. The fundamentals are there. We could absorb 500 million square feet. If we could deliver 500 million square feet this year, we'll deliver about 350. The rents is more a reflection of cost. The big e-commerce users do not really focus on cap rate and rent per square foot. They're looking at the efficiencies that new e-commerce warehouse gives them. So if one particular retailer I worked with in our Monmouth REIT, they said, for every one of these big new million square foot warehouses that we build to do e-commerce, we can close 100 stores. So they're looking at the efficiencies and where those efficiencies are in proximity to logistics infrastructure. So I think we're going to see a slowing and a pausing that's due to the capital pullback, but not the fundamentals. The fundamentals are very, very much in place for quite a long time, years to go here. I don't know what your thoughts are, Michael.
My thoughts are we should keep going because we're short on time.
Okay.
So last time we spoke, the supply chain was still an issue. We were still seeing backups across the globe, which was one of the drivers of inflation. Have things improved, KC, or do we still have more issues on the horizon?
So the supply chain is still broken, but it is shifting. So if you look at LA Long Beach, last year this time we had over 100 ships backlogged. Right now, 4. The backlog has moved to places like Savannah or the Gulf Coast. So the other thing that's going to be interesting is if a lot of these retail excess inventories don't clear here at the Christmas holidays, they're going to have to get backed up in warehouse. So I don't think that, ironically, a bad retail sales season is not going to be bad for industrial because we got to store all this stuff.
Yeah, I think that's a really interesting point that even as retail spending slows, it still might mean good things for the industrial market, at least in the short term. So Michael, we haven't seen any declines yet in industrial rents. Certainly there's a big gap in the coastal markets between what tenants are currently paying versus what they're signing new deals at. Do you have any other insights on this data that we're showing here?
No, I think the chart tells the story. I mean, obviously the biggest gaps are in some of what were the hottest markets in LA, northern New Jersey, and I think it's still a tough place to be if you're an industrial tenant, regardless of where the market's going. The rents, it's going to take a while before the new starting rents are close to what the current in-place rents are.
Yeah, and I'd add to that, think about the industrial rent structure. It's a triple net structure versus full service and office. So the expense increases get passed on to the tenant. So it's harder on the tenant than it is the, than the property owner. And I think the other thing is the rent pricing is really a factor of the cost. Every one of these new buildings costs about $25 a square foot more to build. And the tenant is more willing to say, I've got a return that I'll pay or that I can afford. And so it's really a percentage of cost, and the costs keep going up, the rents are going to go up.
Yeah, I think can we go to the next slide, Ali? I think this one tells the story here. I mean, this is the CPI increase. And you can see, the average escalation within industrial leases was historically a little under 3%. And the landlords have, now been pushing for larger lease escalations, and they're really now catching up with CPI. And, this is a great win for the industrial owners who have, who are able to increase their rents based off of CPI going up, but they're passing through the expenses anyway. And so they're in pretty good shape, compared to the office owners who, yes, they're trying their best to get the rents up in relation to expenses, but they're paying for those expenses. Here, they're just, they're getting more in rent. And if and to the extent that an existing industrial owner is locked in on a good loan, they're still paying low interest, but they're getting escalations, and the tenants taking on the burden of the higher costs.
Yeah, great point. So it'll be interesting to see how rent growth slows or doesn't over the next half year or so. So for the last few minutes, we're going to briefly touch on retail and multifamily. We're going to take a few questions at the end. So if you have any burning questions for Casey or Michael, please put them in the chat and we will try to get to them. So retail, we are in the midst of shopping season. It's well underway. We have the Black Friday numbers. What are we seeing with retail spending, Casey? Is it slowing or not? Retail figures often aren't adjusted for inflation. So what can we surmise from how we performed on Black Friday and over the past few months?
So great question. The headlines were that retail traffic was up like 7%, but the retail traffic to conversion of sales was actually down 7%. And the one metric that I picked up on that, since we're short on time, was CoreSite, great company, does a lot of deep dive stuff on retail, has a new metric that they've been following, which is the cancellation rate in the carts, our e-commerce carts. And so you go back 6 months to a year ago, and the typical cancellation rate was about 10%. As you get all that effort to put it in, you put it in your cart, you're ready to purchase, 90% of the time you close on it. What they found recently is that the cancellation rate's gone to 75%. That tells you how concerned we should be on the e-commerce world of what's happening on the retail sales. I'm not seeing the conversion from the traffic. And the stuff that is backing up, the inventory is backing up, this, the retailers are telling in their earnings, is also telling me that the conversion ratio is not there. So I'm not very bullish on a great holiday season here. It'll be more electronics, less apparel, on that kind of stuff. What about you, Michael?
I don't think I have the same insight that you do, but but I thought it was interesting to hear, when we chatted a bit before about the impact or lack of impact that Black Friday sales and retail sales have on inflation for these types of goods, but which I don't know if we probably don't have time to touch on, but anyway.
Yeah, there's a disconnect. They don't really affect it. I mean, apparel is not a big item. It's the food, it's the wages, it's the energy. Those are the big influencers on the inflation. And whether we have a good or bad retail holiday season is really a rounding error in the overall numbers.
So I think one of the big questions in retail is, how is CBD retail doing as we have sort of lower numbers of people on the streets from hybrid or remote work, and also tourism is not quite back as it was. I know I certainly buy more stuff when I'm in the office, just on my way home. Michael, what have we seen in our data for CBD versus non-CBD, and what are we seeing on high street retail rent?
Well, we saw a huge drop off in all retail, but what we've seen is that it's coming back across the board. Both CBD and non-CBD is coming back, but not nearly as much as the high street retail. So in this case, we looked specifically at New York City high street retail, and what we mean by that is Fifth Avenue, Soho, Meatpacking, Madison Avenue, and Times Square. And what you can see here is that the retail that relates to travel and tourism and recreational shopping has really come back much more nicely than the otherwise CBD shopping, which is maybe tied to people being in offices. So good place to be, I suppose, if you're viewing your retail cost as a marketing expense, and if you're focused on tourism dollars versus office workers.
Yeah, great insights. That concludes our snapshot on retail, and just want to touch on multifamily and the housing market. I think the housing market was the first to sort of feel the impact of rising interest rates. Casey, we can clearly see that home sales are slowing, single family home starts are down. Is there more pain to come for the single family market? And what does this traditionally mean for the multifamily market in a recession or in a slowdown?
Right. So we are in a full-blown housing recession. It's 40% of our economy. The good news of the housing being in a recession is that the construction costs are going to come down for commercial real estate because they're not soaking up the concrete and the copper. So what's bad for residential construction is good for us on commercial. There's a lot more pain to come as existing homeowners see that they've got a 3.5–4% mortgage. they're not going to be inclined to sell and then have to go get a 7 or 8% mortgage to replace what they just moved out of. So we're going to see backup into the multifamily, which means multifamily can continue to move rents up because the entity that would move into a home just can't afford it, whether it's the increased home price, whether it's the mortgage that's doubled, et cetera. And I think that ripples effect into some of the retailers. So on home improvement, we have to wonder what's going to happen there if you're not building as much and renovating as much. So multifamily, I'm very, very bullish on it because there's nowhere else to go. But we'll see people like in office, they'll move down. You'll see people move out of the Class A because of the increases and move down into Class B or move around in the suburbs. So you need to be paying attention to that shuffle because of the rent increases that are double digit. They're not going to change.
So, Michael, we track the multifamily market via our partner RealPage. And here we're taking a look at the top markets for job growth over the past year and how they would rank for rent growth. So we're still kind of seeing a mismatch here, but we've also seen that rents have started to come down. RealPage, I think, announced yesterday that they've had their second month of declines nationally, and that was after sort of 2 years of month-over-month increases.
Yeah, the increases were steep, and I think as we alluded to last time, a lot of the same effect that that KC was mentioning around how in times of recession people trade down to from a 2-bedroom apartment to a 1-bedroom and things like that. Well, we're feeling that now, but I think it's exacerbated even more from the standpoint that everybody traded up to bigger apartments during COVID because they wanted more space. And so it puts them in a tougher spot now if they're out of a job, if they're feeling the pain of inflation, and they are they now have a steeper drop to make to go from one place to another, and it's being felt across the board. And I think the steepness of the growth is a big reason for the steepness of the drop off.
Well, thank you both very much. I'm going to turn it back to Brian, who started off, and I think he has compiled a few of your questions, and I hope that we can get a few of them before we all sign off. Brian, I'll pass it to you.
Awesome. Thank you, Ali. And special thanks to our panelists and our moderator for such an impactful programming today. We'd planned to do a live question and answer session, but we're out of time for today. What we're going to do, though, is we're going to take your questions and we're going to include answers to them from KC and Michael in our event follow-up and on our social media channels. So you will get some answers to your questions. Also, a reminder that the recording for this event, as well as the slide deck, will be distributed for you to view, rewatch, and share with your various networks. Again, we really appreciate you attending today. We wish you the best of luck on your business endeavors in 2023. If you're not following CompStak and Red Shoe Economics on LinkedIn and other social channels, definitely be sure to follow us and check us out. And please be on the lookout for follow-up emails regarding access to the recordings and slides. Wish everybody a wonderful afternoon, and we look forward to seeing you again next time.
Great. Thank you, everybody.